Welcome back, everyone. Today we're jumping right into an explainer on a topic that gets straight to the absolute core of financial freedom. We're talking about the psychological barriers that separate a life of constant financial struggle from true, lasting independence. We're going to dive deep into what actually creates that divide, and honestly, it's completely fascinating. So, let's jump right in.
Now, to really wrap our heads around this, let's set up a little scenario. Imagine two people. We'll call them Alex and Jordan. Now, they both have the exact same starting line. They both make $75,000 a year working in IT support. They rent very similar apartments in Chicago, and they deal with the exact same cost of living. Right? So mathematically, they're identical on paper. But let's fast forward 10 years. Alex is completely debt-free, owns a duplex, and takes month-long vacations without even stressing about money. Jordan, on the other hand, Jordan is maxed out on credit cards, living paycheck to paycheck, and gets completely derailed by something as small as an unexpected $500 car repair. So why does this happen? How do two completely identical financial situations diverge so drastically over a decade?
Well, the deciding factor isn't some secret trust fund or a random lottery win. It actually comes down to an invisible wall built entirely in the mind. It's the stark separation between a poor mindset and a wealthy mindset. And, while it's invisible, its effects on everyday life, overall stress levels, and future stability are incredibly real. This psychological barrier dictates literally everything: how a person views a Friday paycheck, how they spend a random Sunday afternoon, and ultimately, how they design their entire life. Section 1. Mindset Core Differences.
So there's this major contrast in where these two mindsets actually direct their attention and their free time. A poor mindset basically looks to escape reality. Think about Jordan coming home totally exhausted and immediately binge-watching 3 seasons of a reality show until 2 in the morning, just to numb the stress of the day. A wealthy mindset, however, actively seeks out education to improve their reality. Now, Alex might still relax, sure, but instead of pure escapism, Alex is maybe listening to an audiobook on personal finance during the morning commute, or spending an hour on Saturday learning a new skill. It's not that wealthy mindsets never have fun, right? It's just that they don't let entertainment completely dominate their free time. They're constantly looking to absorb information that can be leveraged later.
And that brings us to how these mindsets handle the unknown. A poor mindset instinctively fears risk. Their immediate reaction is to just avoid it entirely. Like, Jordan might keep every single dollar in a basic checking account because the stock market just seems way too scary. But ironically, doing that basically guarantees a loss of purchasing power over time because of inflation. It's safe, but it's totally stagnant. A wealthy mindset doesn't ignore risk, though. They manage it. And managing risk doesn't mean blindly throwing your life savings at some random cryptocurrency. No, it means taking calculated, educated steps. Alex might diversify investments across index funds, or maybe start a side hustle with a strict, predetermined budget of, say, $500. They totally understand that growth inherently requires stepping into the unknown, but the key is they do it with a map.
Section 2. The Value of Character.
This actually brings us to a quote from the text that really stood out. It says, "You can't build $1 million life on a 10-cent character." It points to this deeper foundational truth about integrity and personal development. High-value individuals know that their first and absolute most important investment is in themselves. Why is this so crucial? Well, because skills, wisdom, resilience, and financial literacy are basically the only true assets that inflation can never touch. Markets are inevitably going to crash, economies will shift, and specific industries will definitely become obsolete. But if you spent the time building a high-value character and a really deep well of capabilities, you have the internal tools to rebuild no matter what external circumstances are thrown your way.
Section 3. Power of Delayed Gratification.
So delayed gratification, what does that actually mean? It means you're willing to live like no one else now so you can live like no one else later. It means sacrificing just a little bit of comfort or status today for an absolute abundance of options tomorrow. Practically speaking, it means completely avoiding the trap of buying things just to impress people you don't even like. For example, it's passing on financing a brand new luxury car at some terrible 9% interest rate just so the neighbors notice it in your driveway. A wealthy mindset completely rejects that invisible audience. They're perfectly content driving a reliable 10-year-old vehicle because they know the money they're saving is quietly building their future independence. And the direct result of practicing delayed gratification is a massive shift in what you actually purchase. A poor mindset has a habit of buying things, material possessions like trendy clothes, the latest gadgets, or really expensive furniture that literally start losing value the exact second you take them home.
A wealthy mindset, on the other hand, buys assets. And by assets, we mean things that actively put money back into your pocket over time. This could be dividend-paying index funds, real estate, or even specialized software tools to launch a freelance business. And the goal isn't just to hoard a giant pile of cash. Not at all. They buy assets specifically to buy back their time. They're trading money for the ultimate luxury, the freedom to do the things they actually care about, with the people they actually care about, completely on their own schedule. Section 4. Your wealth lagging indicator. In the realm of wisdom and wealth, we don't just chase coins, we chase consciousness. Now I know, elevating your consciousness might sound a little bit esoteric, but it actually has a highly practical application here. True financial freedom isn't simply about grinding out 80-hour work weeks just to accumulate currency. It's about awareness. It's understanding the exact mechanics of how money works. It's recognizing your own emotional spending triggers. Knowing exactly why you might suddenly want to buy something expensive right after a really stressful day at work. It's about viewing your time as a finite, precious resource. When you elevate your practical awareness of these behaviors, the money basically just becomes a natural byproduct of how you operate in the world.
Because here's the thing. Your bank account is essentially a lagging indicator of your financial habits. Think of it exactly like a shadow. A shadow only reflects the physical actions you've already taken. If you're unhappy with the number you see when you log into your banking app today, staring at the screen and wishing it were higher won't do a single thing. That number is literally just a reflection of choices made months or even years ago. To change the shadow, you have to move. You have to change the daily habits. You have to shift from escaping reality to educating yourself, from fearing risk to actively managing it, and from buying depreciating things to accumulating actual assets. Change the habit, and the shadow will eventually change. It's a certainty born from a fundamental shift in psychology.
Which brings us to the ultimate question. Which side of the invisible wall are you on today? If you really evaluate your daily routines, are your habits leaning toward endless entertainment and a fear of the unknown? Or are they leaning toward education and calculated risk? I want you to really reflect on that. Think about what your current lagging indicators are actually telling you. Let us know your thoughts in the comments below, and definitely don't forget to subscribe to keep exploring and building your own financial wisdom. Thanks for joining me for this explainer, and I'll see you next time.